So I don't know whether I have asked for a nomination or a volunteer.
I'm happy. Yeah.
John has said he's happy. Is everyone else consenting? Thank you.
I can reach the right.
That is the.
We got the.
Sorry, we're just having a quick rearrangement.
Glasses. Fun. Good morning, everyone, and welcome to the Pension Fund Committee at the new venue in the Council Chambers of Shepton Mallet. Please note that this is a physical meeting with officers and others able to observe and participate virtually via Teams. Before we proceed, can I check that everyone in the room and online can hear the meeting? We've got one thumbs up, that's good.
Yep.
When I invite someone to speak, could you clearly state who you are for the benefit of anybody who is listening to the meeting so they can identify who is speaking? The meeting is being recorded and will be made available to view online. Can I also warmly welcome any members of the public and media who are joining us today. The agenda pack for this meeting is available via the ModGov app or directly from the council website via the link which was sent out last week. As agendas are now viewed electronically, could I kindly request that members and officers refer to the page numbers from the published agenda pack to assist all present in finding the appropriate information. Thank you. First item, apologies for absence. This should be interesting.
We've got apologies from Councillor Peter Sieb and from Councillor David Fothergill, and a message from Councillor Farbahy and Simon. He said Simon, so I presume he means Simon Coles, are stuck in traffic and they'll be here shortly.
Okay. Any declarations of interest? Thank you. Minutes from the previous meeting on 13th of September, excuse me, 13th of September 2024, pages 9 to 14. Can I approve those as an accurate record of the last meeting? Sorry? I can do. Is there anything on these meetings that anybody would like to bring up? No? So can I have a proposal? We pass those. Seconded. Thank you very much. That's passed. Public question time. Do we have any?
There is a question from Sigurd, yes.
Excellent. Would you like to go ahead with your question, please?
Good. Most of you will have seen this question in advance, and
I also wrote individually to those councillors whose email address I have. And very interesting reading Anton Sweet's contribution as well, which I read yesterday. So it seems strange asking a question to which I already know the answer in a way, but here goes. The government is planning to create a revised LGPS pension scheme next year. I understand that this will involve transferring all the remaining assets to the individual administering authorities into their respective pension pools. For our own AA, this seems to involve relatively small changes, as our AA has already transferred the vast majority of its assets to our pension pool, Brunel Pension Partnership. I gather that Brunel, along with the other 7 pools, is likely to continue operating, but with enhanced powers for making investment decisions, albeit within a strong government framework. I can see some benefits from economies of scale from such a change. The government's emphasis on investing in local infrastructure projects could be of value to this country. What concerns me is that despite numerous references in the recent consultation document to transparency and the passing of information, we could end up with a very large pension scheme that will be harder to hold to account. The model being proposed is based on the Australian-Canadian pension schemes, so-called mega funds. The latter of these has, of course, been heavily involved in the controversial takeover of a number of UK airports, including Bristol Airport, where massive expansion is being planned. It seems as if the Canadian scheme also has recently just been able to remove its portfolio from the troubled Thames water. Both schemes, of course, fall foul of ESG principles. I'll be interested in hearing discussion of the consultation under item 21 of the agenda on the Pension Fund Committee on 13th of December, today. My question then is whether the Pension Fund Committee and or its councillors individually are planning to submit their response to this consultation, where admittedly the main decisions have already been made by the government. I'm particularly concerned that although economic, social and governance matters are mentioned on a couple of occasions in the document, it would become harder to hold a mega fund to account over its operation in examining ESG matters, including climate change. Will our own LGPS be left holding the accountability for its investments but have less influence? Will the pension fund board have a stronger oversight as well as supportive role? These are some of the issues I've included in my own response to the consultation document. I'd be very interested in knowing of any other contributions being made by yourselves. Thank you.
I'm just going to pause there because Simon Coles, as chair, has just arrived and he's sorting himself out. Simon, would you like me to read the response to Sigurd whilst you?
Please, if you wouldn't mind. Good morning, Sigurd.
As usual, Sigurd, we have a prepared response and I will email it to you once I've read it to you. And as you said, with your question, slightly redundant because you know that there's going to be a response. I suppose my answer is slightly as well, but I shall carry on. The Pension Fund Committee intends to formally respond to the government consultation on behalf of Somerset Council in its capacity as an administrating authority of an LGPS pension fund. It is not for the committee to comment on whether Somerset Council intends to respond in another capacity or individual councillors intend to respond. There is much detail to be filled in by government with respect to the proposed changes to the workings of the LGPS, and discussions will be needed between Brunel Pension Partnership Limited as our pool company and all of the owner-client LGPS funds associated with the Brunel pool as to how we precisely implement those changes. However, it is our current belief that Brunel's leading focus on ESG matters will remain a core part of the pool. There is nothing in the consultation to suggest the roles of Pension Fund Committee and Pension Fund Board will be materially changed beyond the specific changes to the production of investment strategy statements. That is the end of the response.
Okay. In that case, moving on, item 7 on our agenda, and we're going to go to Rachel from Peninsula Pensions. Rachel, good morning.
for the benefit of those in the room and at home, Rachel has asked to be moved up the agenda this morning as she has other pressing matters. So that's why we're taking Rachel first.
Okay, thank you.
Good morning, everybody. Thank you. I really do appreciate this, moving me up the agenda. So I'll just give you an overview of the administration report and where we are with that. So as usual, our performance is measured against the Occupational and Personal Pension Schemes Disclosure Regulations 2013. So this report relates to Q2 for the quarter ending the 30th of September 2024. And the performance overall for all of the areas of work was 87%, with high priority work areas, which are the retirements and survivors benefits primarily, were at 92%. So you will likely notice that the 87% overall is in fact lower than it was for the previous quarter and for the previous year as well over the various quarters. And just to give you a little bit of background to the reasoning why that happened was we did have several staff move to a different administrator. So we effectively lost one of our pension teams that do the calculations. We've managed almost straight away, fortunately for us, to be able to recruit to those posts. But obviously the individuals that have been recruited do require some training, and therefore we had a drop in performance for that quarter, which is expected to raise up again higher for the next quarter. Team received overall for that quarter 16 different compliments that were recorded and written down. Individuals went out their way to report to us, which was nice, having some compliments instead of complaints. You will see Appendix 1 confirms the breakdown of the percentages that I was just referring to a moment ago. So there's all the different areas and breakdown in Appendix 1 on the report. And the main category that has dropped is the lower priority cases. And what we've done is part of learning, it's obviously easier for individuals when they're being trained to learn the more simpler, if there is such a thing in pensions, simpler calculations. And therefore, that's what they're being trained on at the moment. And so that's why I'm confident that the next quarter, the performance will improve because they're working and focusing on that area. So during that quarter as well, we also had annual benefit statements to issue by the 31st of August, and we managed to achieve the annual benefit statement date of the 31st of August in advance of both active members and deferred members in the local government pension scheme. And the numbers are there. You'll be able to see that primarily now the statements are being issued online via our member self-service online portal, Engage. So there's been there's a good uptake there. Still have some paper copies where individuals have opted out, but the main priority are now electronic. We're also working on with the National Pension Dashboard. We're due to have a connection date as a public sector service scheme of the 31st of October 2025. So we chose with our software suppliers to do some testing in advance, a year in advance, because that year goes quickly and it's quite a big thing to ensure that we've got that secure connection up and running. So our systems team have been doing that testing and have just completed stage 1 of the testing in advance. Stage 2 isn't until next year when they can do a bit more, but stage 1 was successful. So it's working towards that date, looking good. We've also got on some of the other reports, appendices, you'll see there's a breakdown of complaints that was requested previously as to what types of complaints that we'd received. So there's an outline there of what they are. And on page 32, which is Appendix 2, you will be able to see a chart of work that was outstanding as at the 30th of September, at the end of that quarter. And the second graph on that page is just showing you how much of that is outstanding and with ourselves as administrators, and how much is on what's called reply due. So we're waiting information either from the member or from employers. And you might just see a significant twist, if you like, change on that graph, sort of February, March time, where it flipped from work being outstanding to with employers or from members to give us information, to the information being with ourselves. And that, I think, sort of ties in a bit nicely with the admin strategy when that was reviewed, or there was talk of it being reviewed at that point, and then obviously approved at a slightly later date. But it does look like the encouraging employers to get the information back to us with outstanding queries has worked. Just saying that, which is really positive. So they're working with us well. There's also on Appendix 3, you'll see that we are watching the incoming work and how much we're receiving on a rolling 12-month basis, and it is continuing to increase this period, October to September, compared to the previous October to September. So obviously we keep an eye on that, and when we meet with Anton for our shared service meeting, that's sort of part of information that we would discuss if we were at any point concerned about resource levels with staffing with that increasing work. So just so you're aware, that obviously is monitored. And that is a brief overview. I don't know if there's any particular questions, and I'll answer them.
For your report. Michael, you've got a question.
I apologise for not having read your report in its entirety, but I just, because I've had recent experience in taking a pension, not with a local government, but a privately invested self-employed pension, which was a nightmare because I wanted to retire in June, which was my 70th anniversary, and I wanted to take the pension. And it took so long, and they made so many mistakes that I developed a heart complaint and then applied for an enhanced annuity because I thought that was worthwhile, which I'm now still waiting for. So I wondered what sort of mistakes you think you're getting. Is it human error, or is it something to do with a computer program? Because every time I got sent another pack, there was always a mistake. And this is Phoenix Life. I don't mind saying who it is. But they were very... I complained twice, and they supported both my complaints and paid me. Do you have a sort of breakdown in terms of how the complaints are caused in your instance?
Yeah, the complaints for this quarter, I've given a brief outline on, let's have a look, the page 31, what the types of complaints are. So I can certainly just give you a quick overview if you like. So we had 9 complaints for the quarter. 5 of them were relating to the statutory timescales and regulations around different types of calculations. So, for example, with refunds or deferred benefits, the timescales that are in the legislation is that you need to have at least 2 years service to be able to have a deferred pension. And some individuals obviously don't necessarily understand that and would like to keep a deferred pension but have to have a refund at that point. So it was items like that. So the 5 statutory items were legislation driven, which the individuals didn't necessarily agree with, but obviously we have to stand by. 3 of them were third-party delays, so we couldn't do our calculations because we hadn't received information from others. So it was primarily either employers or if somebody moves from sort of one administering authority to another, they have an interfund of a payment, and there were some delays there that we had to sort of chase up. But obviously it's tricky when you're reliant on other people giving you the data. All we can do is ring them, ask them for it. And the other was some correspondence that was issued where the individual had actually very helpfully given some feedback, which meant that we made a change on one of our letters to make it clearer. So we like that feedback, because obviously sometimes it you know, we understand it as administrators, but it's, if we get the feedback from individuals and then you can understand why it wasn't clear, we can change it. So that was more feedback than a complaint.
Thank you. Yeah, I think that just sort of that sounds to me like it isn't a computer problem. It's not something to do with your computer system that's sending out wrong quotes or wrong. And I think that might have been the case for me. And I think having someone you can talk to who genuinely can sort out a complaint means that, I think, beyond a certain point, I think if you had a much bigger area to serve, you might struggle with keeping a control over that. And I think the size you are at the moment seems to be working quite well. Do you agree with that?
We've got plenty of members to be dealing with at the moment. Yes.
Okay. Thanks very much.
Okay, you're welcome.
Thank you, Chair. Thanks for the update, Rachel. I've got two questions, if I may.
Yes.
We've talked previously about staffing levels and the impact on performance and ensuring that we were taking account of turnover. And I note that your comments about performance dropping off due to turnover again. Can you just confirm that the staffing level that's required to keep performance at the appropriate level, does that take account of normal staff turnover, or does it assume automatically that you've got full establishment in order to deliver performance, and that if ever there's turnover, it will drop off? I just want some assurance there. And the second question was about McLeod. From the paragraph 6.1 in the report, it seems to be saying that you expect to be up to date on McLeod by 31st of August. Could you just confirm that, or am I misreading that short paragraph? Thank you.
Yeah, of course. So yes, for the first question, yes, the resource takes into account the amount of workflow that we have in to ensure that we keep on top of that, even taking account of succession planning as well. So that it does take account of that. We do have to, with it, the workload constantly increasing, sort of quarter on with the comparison, we do need to keep an eye on that every month, really, and just make sure that we're still where we need to be. So if there was a problem and I felt that we needed more staffing, then obviously I would definitely highlight that. Our senior management team would highlight that both to Devon business team and to Anton as well. So yes, at the moment the resourcing accounts for the change of staff and takes account of when individuals are due to retire. We have all that in sort of all scripted as well, so we can see that clearly. With McLeod, so the McLeod is always going to be ongoing, but the paragraph that it's referring to in the report is those individuals that have already left and need recalculating. So we've identified how many there are, and they're in the report. So the statutory deadline for that is we need to have those done before the next annual benefits statements or next information goes out to individuals. So they need to be done by the 31st of August next year. But obviously, ideally, we would like to work to an earlier date. The original date is the 31st of March 25, but there is a discretion to go beyond that as long as they're done before distribution of statements are due. So the ones that need recalculations and need revisiting, some of those will be like transfers where individuals have had transfers in, potentially transfers out, as well as pensioners, or where individuals have passed away and there's been a death grant. Those cases are the ones that we're talking about that need to be revisited before annual benefit statements or before that 31st of March deadline. So we have a project team in hand that are working through those at the moment. As far as McLeod beyond that date, that will just be business as usual. So when we do calculations going forward and individuals leave, that McLeod formula and underpin will be part of that. So we will work that out at the time that the individual does actually leave. So it's sort of two-part, the work is the project work, which is the recalculation work.
Just for members' benefit, it doesn't matter if you don't have a figure. What sort of proportion of the overall membership are impacted by McLeod? Do you have a vague feel for whether it's half, 2/3, 3/4?
That's a good question, Anton. I'll tell you what, I can certainly get that information to you because we have that, but I don't know what it is off the top of my head right now.
No, that's fine. It's just, yeah, we've got roughly 70,000 members.
Yeah.
So I think it'd be interesting for the committee to just find out how many members this impacts. I've got a feeling it's quite high, but it does require you to basically be working at the 31st of March 2014, doesn't it? You had to have been an active member at that date to be impacted by McLeod.
That's right.
Yeah.
That's right. Yeah, but I can certainly forward you that information so that you can forward it to everybody. So we definitely have it. I just don't have it right now to hand.
Thank you, Rachel, and I look forward to seeing the email.
Okay, you're welcome.
Are there any other questions for Rachel? I'm not seeing any. In that case, its recommendation is to note the report and the actions undertaken by officers to ensure compliance and best practice. Are we content with that, committee? Yes, we're content with that. Do you want a formal vote, Anton?
I think
No.
so.
Okay. In that case, we're going to go back a step. Thank you, Rachel.
Thank you.
Look forward to talking to you soon. You're welcome to stay, of course. Delighted to have you stay for the rest of the morning. But I understand you've got pressing engagements elsewhere.
I have, I'm afraid. We are moving offices.
Ah.
So yes, very
always a fun time. Yeah. Okay, well, thank you very much and have a wonderful Christmas.
Thank you, you too.
Talk to you very soon. Bye-bye now. So we're going to go back a stage to item 6, which is pages 3 to 24. And that is to consider the report from the fund's investment manager.
I'm going to take you back a step further and
to
5 and have Caroline's independent review.
My apologies, Caroline.
Well, you have, I hope, all seen and read the report that I wrote. I'm happy to expand on anything that anyone would like to pick up or to answer questions on any investment topic you like to throw at me, though I don't promise to have answers to all of them.
Okay, questions for Caroline? Seeing it online. I'm shocked. Anton, we have no questions for Caroline.
I'm trying to think of one.
Yeah, please. It's a small embarrassed silence.
Oh, Paul's got me off the hook.
Help.
It's not so much a question, almost a mea culpa. I think that part of the reason for the lack of questions is it feels like we've entered a bit of a period of hiatus where we've had a really clear steer from the market and from Caroline as to the direction of travel. The only variation from that seems to have happened over possibly the last year is about timing and rate of change. And I think that the lack of question is we've just had a budget. There are things going on in the world, but actually it will be crystal ball gazing, and it's really hard to coalesce any of those questions. I've got lots of questions, but I don't think Caroline could provide the answers to the impact of the things we want to know about.
In the current circumstances, I think it would be so amazing if Caroline could, and as you say, it would be crystal ball time. So I'm not that surprised there aren't many questions, but it's always vaguely embarrassing.
Well, I hope it was still useful nonetheless.
Yeah, indeed, but we are in that very, very strange position where we're expecting the government to give us some to put some meat on the bones for us. And at the moment, there isn't any. So I don't really want to get into a half an hour speculation because I don't think it's useful. So that report is also to be noted. So I'm going to suggest that unless there are any reasons why we shouldn't note that report, if anybody wants to raise anything particular, I think that's what we'll do. We'll note that report. Okay, we'll now move to item 6, which is pages 3 to 24 on our papers.
Thank you, Chair. As usual, I'm going to restrict my introduction comments to the combined fund figures, which start on page 17 of the first supplementary pack, but happy to take any questions on any part of the report.
Okay.
So the return for the whole fund at 1.1% is reasonable. I mean, in terms of our sort of overall sort of target, which is sort of a couple of pages further on, of 4.6% a year, 1.1% is pretty much exactly there or thereabouts. And actually the summer was a relatively quiet period in terms of markets. We've had a lot more sort of impact in the fourth quarter, calendar quarter. Particularly, I will let you know that returns in November were very strong. Whether we like him or not, Trump's election was seen by the US market as being a good thing, and US share prices in particular rallied very hard in November. Going back to the quarter, as I said, absolutely fine in terms of performance, but nothing particularly special. I'll just let you note that in 16.5, I've reached the point where I have quarterly data in a comparable manner that I can add a 20-year number. So I have done so.
Okay.
And apparently we average 11.1% per annum over 20 years.
That's pretty good. You know, I think you should be rightly proud of the work that's gone in to achieve that on a 20-year spread, because I think
it does help that 20 years broadly starts post the .com bubble burst. Yeah. So it started, it actually kicks in just after. So a rally started sort of March to June 2003, just after the start of the Second Gulf War, which sort of the start of the war effectively gave markets some sort of feel for the direction of travel. So having that good starting point sort of does help. But obviously we do have the global financial crisis in there. But that's really the only significant period of drawdown during that 20 years. It's been slight, I mean, Caroline's slightly longer in the tooth than me. I'm sorry to point this out. But I would have said it's quite unusual to have 20 years with really only one significant drawdown period.
I think so, yes.
Yeah. Of course, Sean.
What is the market growth of the last? We've got a return on the fund, 11%. Oh, sorry. We've got a return on the fund for about 11% over 20 years per annum. What is the market?
Well, the figure you've got here, of course, is a mixture of blended assets. That's not just the equity market. And I'm afraid I don't, in the top of my head, have a 20-year equity market figure. I don't know whether Anton does, but this is bonds and property as well.
Even if we start talking about an equity market figure, do you want a global figure or a UK figure?
I would think a broad figure, to be honest.
I'll look something up. And I can find something.
If you want that to the email which circulating to me.
Yes.
From Rachel, is that okay?
Yes.
I mean, I do think that we should be reasonably happy with a 20-year performance at over 11%. I think that shows good, strong fundamentals for us. And I think we should be.
I would
Not
hazard a
unhappy.
guess that the stock market performance is probably something like 13 to 15.
Sounds about the right sort of area, doesn't
Yeah.
it?
Because
Yeah.
generally speaking, bonds through that period, probably somewhere around 3.5%,
Yeah.
maybe a bit lower. So
And probably
Just-
somewhere in the middle, yeah.
yeah, just sort of what feels about right in terms of our mixed assets. That I would suspect it's in that sort of area. Just moving on to page 19 then, the performance against the absolute target, which is also the figure embedded in the actuaries' 3-year valuation cycle. You'll see we're just above the target. It feels like we're going to get to March next year, there or thereabouts. And if you then look at page 22 and the actuaries update, you can see that on their current projection is that we're sort of about a 1% behind in terms of funding level where we were last time. It looks like we're likely to have slightly lower primary rate contributions than last time out across the fund. So that's the cost of an additional year's service for each person in the fund. Because we're slightly lower on the funding level, we might see a slight uptick in deficit recovery, but broadly speaking, we're expecting the cost to employers to be pretty similar post the valuation than as now. That's true for the big employers. Obviously, small employers' results can vary because when you've got 30,000 members in for one employer, Somerset Council, then you can feel that it's going to be very close to that. When you've got 6 employers in, where 6 members in, which we have for some of the smaller employers, then obviously their results can be quite volatile.
And indeed, one change out of year can make a unreasonable difference.
I have no particular other points that I would like to raise, but I am happy to take questions.
Okay, committee, questions for Anton? I'd like to ask you, Anton, if we hit those figures, at what point do we anticipate that we will be fully funded?
I'll stick to the mathematical answer to that, because the answer is with markets moving, you never quite know. And
I accept that.
And I can't remember the context in which I saw it, but I read something recently, which I think it might have been a press report or something, which seemed to imply that once we get to 100%, we automatically stay there, which is not true.
No,
markets.
Sorry, I wouldn't accept that as a comment from anybody. I mean, that's
markets.
Nonsense.
Yeah, markets can fall again.
Yes, quite.
But
2008.
I think it was I think I'm right in saying it was the 2010 valuation. Was there a valuation in 2010? Yes. That we instigated a 25-year deficit recovery plan. And we are still working to that without adjustment. So I think we are aiming for 2035.
Right, okay. And do you think that still appears reasonable? You've got 10 years to achieve it?
On the assumption that the deficit recovery plan and Barnett Waddingham's assumptions are accurate, which is a very dangerous statement, I see no reason why we can't meet it. I mean, at somewhere approaching 95%, whilst it is mathematically necessary to continue to aim for 100%, we're close enough that it has no significant impact on how we need to act in managing the fund.
Managing the fund and being able to pay all of our employees.
All our liabilities as they fall due.
Liabilities.
Yeah.
Okay, that's good. I wouldn't. I fully accept that we're looking at figures and we do not know and will not know until the events have happened, whether or not that will be in that 10-year window that we have.
Yeah.
But at 95%, there's not too much stresses on the on our ability to pay our liabilities currently. Long may that continue. Questions for Anton? Not seeing anybody online.
Michael.
Oh, sorry, Michael. Sorry.
It's just idle curiosity, really, but
Yeah.
I'd love to see another graph about the number of our clients, if you like, against the change of value fund a graph, because it is that related to the input is increasing, or is it just the fund that we have has suddenly gone up? Which is quite an impressive graph when you're talking about billions.
So the vast majority of the impact is investment returns, not the cash flows of the fund. So I'm just there's effectively the net cash flows of the fund is in a later item, and I'm just rushing through the pack. So in the 23-24 year, the net impact was about £2 million of money going in and coming out. Sorry, that's after investment income. So in the current year, we're actually, for the first year, predicting that we'll be cash flow negative. So we'll spend more on benefits and expenses than we get in on contributions. But it's in the range of sort of £20 million. So in November, where I think returns are going to be, I think it was about 3.5% for the fund, and that will equate to about £100 million growth in 1 month. So market movements, I can split out the numbers for the last 20 years, but market movements, the investment fund movements vastly outweigh.
It shows how reliant in a way that we are on the market being favourable in a way,
but in the long term.
I know it's got to look longer than 5 years at any scale. So fingers crossed.
I mean, Anton made the point, I thought very well, that in that 1 month there was £100 million of extra income.
Or extra return, extra value.
Value, which is it's an extraordinary month. I think Anton's description of November being very strong is apposite. But yes, I think overall, we look at 20 years with a couple of hiccups in it, 11.1%, and you look at that liability of somewhere around 20 million, and that 1 month's fluctuation was a valuation of 100 million. I think we can be reasonably comforted by all of these figures, that we are in the right ballpark, and that we are in good hands.
And I'd only add my concerns, as I would as a Green Party councillor, that if we don't deal with climate change in a timely manner, I'm not talking about this country, I'm talking about worldwide, all stock values will be severely compromised by effects from climate change. And I just can see that on the horizon. And there's nothing much as a committee or as a pension fund we can do about that, presumably, in terms of mitigation or preparing for it.
Would you like to answer?
There are actions we take to make sure that our investments, where possible, don't make things worse, and our own actions in terms of running the fund and as a council. So those are the things we can control. Ultimately, you're right in terms of global stock markets and whether we get to a point where climate destroys cities, not impacts, destroys, etc. Then sort of bets are off, and yes, there will definitely be some negative consequences on stock prices.
Well, fingers crossed yet again. Thank you.
Can I just ask you a quick?
Of course, Harry.
Can you hear me? Yeah.
No, it's not on. Right, it's not on.
There you
You're
go.
on there.
Just a quick question of you, Antoine. On page 17, for the quarter, on Brunel Private Equity and others, relative to the benchmark is slightly lower. I know the whole sort of level of absolute return is positive. Is there a specific reason for that to be lower?
So with the private equity, there are a number of factors that need to be borne in mind. Firstly is they don't price in the same way. So with a listed share, so if you own Vodafone shares, there is a price that's quoted by the stock market that's updated every second. And so at any given point, you have a good feel for what you can buy or sell that share for. With private equity, that's not the case. You're usually doing a valuation of any given company based on a multiple of income or value, or or sales, and sometimes if it's a very early stage company, you're effectively guessing. And also those numbers, because they're more accounting numbers, they adjust very slowly. There are some impacts with private equity also around where you are in the life cycle. So for the Brunel funds, most of those funds being post 2020 are still quite early in their life cycle. And so you're buying businesses and you're investing in businesses rather than reaping returns from businesses. The other thing that happens is that because the majority of both our Neuberger and Brunel holdings are priced in dollars, because the pricing doesn't move as quick, the FX has a more noticeable impact on what we're reporting in each quarter, and the dollar was weak against sterling in the quarter to September. So there's a number of factors there. So whereas you can draw some conclusions from the listed assets in terms of a quarterly performance, for the private equity assets, I give you quarterly performance, but I would suggest that it is broadly meaningless. And really, it's the 5-year numbers, which we don't have for Brunel yet because that particular pot hasn't been going for 5 years, that you really need to look at.
This is just an indication.
It tells you what happened to the value of that asset during the quarter, but it doesn't tell you what that asset is doing for us over time. Yeah, it is what it is. I don't know if Caroline has anything to add to that.
Not really.
No.
You shouldn't be looking at private equity over anything except 5 or probably 10 years. You aren't going to know whether your private equity program has been a success until the fund is finally wound up. So it's a number to put in the box, but it probably isn't worth much more than that.
Sorry, I'm not seeing anybody online with any questions and nobody in the room. So that again is a report to note. And now we will move on in our agenda to item 8. No, they've just done that. Sorry.
No, item 8.
Item 8. That's Anton again.
Thank you, Chair. So we're now the business plan update on page 35 and 36. I shall just quickly take you through the progress since the last quarter. So obviously, Rachel alluded to, we're working quite hard on McCloud at the moment. Yeah, we're always keeping track of anything that comes out of government, but on technical matters, isn't much coming out. As an update on the external audit of the pension funds to 23-24 accounts, that is completed. A audit findings report was presented by Grant Thornton to the Council's Audit Committee on the 12th of November. And that indicates that the pension fund will have an unqualified opinion. They will not release their final report until they do Somerset Council's accounts. One thing that I have clarified is that the pension fund's opinion will not be impacted by any consequences of the council's accounts being qualified or otherwise, which I understand, given the pressures of combining them and the new system, there is a greater risk of. So the pension fund will be given an unqualified opinion. It's just when we will formally get it. I believe that due to the government's backstop legislation, Somerset Council's accounts will be, I'll call it dealt with rather than anything else, by the 28th of February. I look forward to an emergency audit committee on the 27th or 28th of February. That's just a cynical view. So good news for us in terms of that. The pension funds accounts are all good. I refer to the government's consultation in this report, but we'll obviously come to that in full later. One specific thing for the business plan is the government consultation does indicate that investment strategy statements will be, there'll be new regulations and guidance on the production of those. Committee will remember that we were due to produce a new one by the spring. Yeah. I suggest we pause that work. It seems little value in coming up with a new investment strategy statement for the March or June committee meeting to then have new guidance, which means we have to go through the process again in, I don't know, maybe December next year or March 26. And I am content that our current investment strategy statement is fit for purpose in the interim. There is nothing in it that frightens me. And indeed, when we came to those discussions, my opener would be, we don't have to change anything. There is no specific reason to change anything, but we are happy to change things if you would like to. So we will await that new guidance rather than do that work now, unless the committee specifically wishes to make work for us all. Well, no, it is your decision.
Yes, but I think I can see no reason why we would want to do that.
Yeah.
I'm perfectly happy to listen to alternative views. But I don't think there's any point in doing the work now and doing the work again when you actually know what the questions are.
Yes.
I mean, I guess a certain amount of work with investment is speculative, but that shouldn't be about your daily workload.
No.
So I'm not going to propose that we make any alterations at all. I'm not seeing anybody making any other suggestions. I can't see anybody else asking questions.
I have nothing else on this matter, on this paper to say, so
okay.
Questions?
Well, in that case, if there are no questions, we'll move on to item 9, which is a finance and membership statistics update, which is 43 to 48 of your pack. And where we go, Anton?
As usual, the membership statistics is much for noting and just general information. The trends that we've seen over some time are perpetuating. So a gradual increase in the number of deferred members, gradual increase in the number of pensioners. There was a noticeable step change down in the number of active members, approximately around the point that the Unitary Council was created. And we are broadly flat since then.
But that's what you would have expected.
Yeah.
Yeah.
In terms of then the financial projection for the current financial year on page 47. So firstly, to confirm that certainly based on the evidence of this quarter, the issues we were having in terms of the timeliness of data into the new system and our ability to extract information from that system appear to be corrected, because I was actually very surprised at how tightly in most categories the profiled projection for the year is sort of, the actual is actually very close to the budget figure. So I'm assuming all is good, and I'm certainly far happier that that position is correct, that we're in a good place. The only change to the full year projection I've made is for investment income, where clearly we're collecting more income than was anticipated when we did the budget figures. And there's no point in denying that. So I've now assumed that although that we will get slightly less in the second half of the year than in the first, principally because I expect lower cash returns, but we should be broadly double at year end where we are now, slightly less than. So that's the only adjustment to the full year projection at this stage.
Okay.
Happy to take questions.
Okay. Committee. Paul.
I'm almost loath to say it, but it seems like when we have a difference in the figures, we say, okay, that's a lag. And when the figures match, we say, oh, the lag's disappeared. But I'm not sure that actually in itself gives us confidence. We've got a projection. If it's below, we say there's a lag. If it's above, we'll say, oh, they've got ahead of themselves. And if it's the same, we say, oh, we're doing well, it's spot on. It's just really difficult to really understand that difference, isn't it?
And it is. We have had a tricky year to 18 months with these, where my confidence in what's in the system has not been great at times. I am more confident now for two reasons. One, because the numbers look vaguely sensible. That always just gives you some level of assurance, even if it's misplaced. But also because now I have since April, I have direct management control of this, and I'm speaking to the people who are inputting and reconciling those numbers and looking at their reports to me in terms of how far they think they are behind, what is unallocated, etc., etc. I have far more confidence now that they are broadly on top of the workload in the vast majority of areas, and therefore the figures are right. Yeah, we're basically running on the contribution side. The unallocated figure is sort of 6 weeks, which is what I would usually expect, bearing in mind that contributions typically aren't due till 3 weeks after the end of the month. So you expect a 3 week lag, and then about a 3 week lag in terms of that reconciliation and posting of that correctly. So I have more confidence, not just because the numbers look sensible, but because I know what's going on behind them. And hopefully that explanation gives you slightly more confidence.
It does give me slightly more confidence, thank you. I mean, you know, a management accountant will always say if the trading performance is worse than they predicted, well, there's income lag. If it's better than expected, there's an expenditure lag. And if it's spot on, isn't he brilliant? I think what I'd say is that does give me some more confidence, what you've said, and I look forward to seeing that sort of maintained now at a consistent level going forward.
Yeah, and yeah, the proof is always in the pudding when we get to year end, and I suddenly sort of announce something that's quite different. But contributions and recurring pensions, lump sums, I have a lot of faith in. Transfer values are always a little bit more, they're more difficult to chase up. They're more sort of granular of having to do a bit more work. So, and they are random in nature. So there's more chance there that we'll get something that comes out of the woodwork. And management expenses. I mean, the thing with the management expenses is on the investment expenses side, so much of that gets posted in the final quarter. In fact, so much of it gets posted in post year-end adjustment, actually, because a lot of it is non-cash items within the investment funds themselves that we're required to account for at year end, and we only get the information after the year end date. The chances of that being different are significant, and also because they are related to the value of the fund. If the 4% uptick we saw in November holds, and perhaps we got another uptick for some reason, then clearly our year end value is well ahead of what would have been used to predict the costs.
And therefore the cost will have been.
And therefore the cost will have increased,
yeah.
But the value of the fund more than mitigates that.
But there is nothing in this set of figures and the last set of figures from a few months ago that leads anybody, I suspect, to think we're off course or out of kilter.
We are, as much as I say, as much as one can tell, I think we are broadly in line to end up roughly where we predicted at year end.
Yes, I think, looking back over the last few years, I think we're pretty close to being where we need to be.
Yeah.
There is always the unexpected, of course, and we are talking about markets, so these can change, and no doubt will. Okay, questions from anybody else? Not seeing anybody online. In that case, this report is also to be. Oh, sorry, Michael.
I'd just like to comment on how much work there is to put in the background to this piece of information. It's quite frightening to look at in a way, because you know behind every total there is a lot of work, and it just goes to show how complex this fund is in terms of how it works and how it's measured. So I suppose that's a thanks from me.
It's true of all of this. So the investment performance figures and everything, and calculating and producing that paper, there's quite a lot that goes on behind. Rachel's work, obviously, there's vast amounts of work that creates each of those sort of cases that we just look at 20,000 cases and go, 20,000 cases, oh, that's great. 20,000 cases is quite a lot of individual pieces of work. And yes, to keep track of the costs and accurately reconcile of 20,000 pensioners being paid every month and 140 different employers paying us contributions, it's quite a lot of work.
Okay, well, we agreed to note that report, so we're going to move on now to item 10 on your agenda, which is pages 49 to 56, and this is the review of the pension fund risk register. Anton.
So I'm just going to, there are two changes to the risk register that are highlighted in the report, and I'm just going to speak to them briefly. So it was pointed out to me that by a fellow officer, actually, when they reviewed this, that we had a couple of risks in here where we had our current score and the target score. The two were different, but there was no mitigation suggested. And that seemed to be a rather odd intellectual leap.
Yes.
Because if you're not going to do anything about your current score, how is it ever going to improve? Those were specifically around PF Admin 6 and 7, which are basically the two cybersecurity, data security risks. We had the informal session for committee and board with the cybersecurity experts of Haywoods and Devon in, I'm going to say September, but I can't remember if it was September or August or when, late summer, early autumn. When I reviewed this with the board at their meeting in October, and we discussed that, it was agreed that, broadly speaking, we are doing as much as we can on cybersecurity, and therefore the long-term target was unrealistically optimistic, and that our current score was reasonable regarding the long-term position on cybersecurity and data protection, and therefore I have increased the long-term risk to match the current position, because we feel we are doing all that is reasonable. And with data, there is that inherent balance of keeping your data secure, but also having sufficient access to it so you can use it. There is no point in having data which says we must pay this person their pension if no one can access it, and therefore we fail to pay the pension. So there is an inherent balance there. I'm happy to have a discussion in a second. I will also note that following on from Stephen Morton taking voluntary redundancy at the end of October, there were a number of risks that were assigned to Stephen, specifically in the risk register, and certainly in the short term, I've reassigned them to myself, which is bold of me. But we will, so you will, when we get to the conversation around the consultation, you'll see that one of the government's proposals is to have a senior LGPS officer for the fund. And again, the devil will be in the detail in what government prescribes for that post, which will broadly be a statutory post, as I understand it. And so once we've got through that and the current review of structures within the council, we may look at all of the assignments again to see how they best fit with those new arrangements. That's not to say they will change, it's to say we will look at them all again.
Yes, I think that's a perfectly reasonable stance to take at this moment.
I'm happy to take, as ever, to take questions around any element of the risk register.
Okay, John.
Thank you. I'll turn my microphone on. A lot of talk at the moment about the risk to cybersecurity with the quantum computers coming on, and particularly with the testing of Willow, Google's quantum computer, and what that will mean with the ability for certain agents, if they get hold of this technology, to be able to crack codes. I mean, I know it's early and it's not sort of on our doorstep at the moment, but are we joining any groups of pensions that are thinking of tackling this when it becomes much more of a threat? Are we looking at as a horizon threat?
So our principal risk in terms of cybersecurity and data security is the membership database, which has details of every individual who's a member of the fund, their age, their national insurance number, their service, and for those receiving a pension, their bank details. That is a piece of software that is remotely hosted and provided by Haywoods. who I believe the Hayward system, I think, is used by something like half of the LGPS. So in that sense, we are working with and part of a much bigger entity than just an individual council. And that's, as I say, that is the principal risk. Ultimately, quantum computing, I mean, cybersecurity is like any security, it's an arms race. You put a new lock on, the criminals work out how to pick that lock. And if they get, they'll use quantum computing at some point. They will. Inevitably, at some point, it will become ubiquitous, and they'll be able to use it to crack cybersecurity. And those providing cybersecurity will use it to come up with new and ingenious ways to prevent hacking. And it's, that is the nature of the beast. We are doing as much as we can, and we take it very seriously. And hopefully those that attended the meeting with Haywards and Devon were reassured by the actions they were taking. But there is a reason why I suggested that actually we need to change the target score to 12, and it's an amber list, because we can't guarantee, and it's always going to be a risk.
I was just saying, you will not be able to realistically guarantee, because technology moves on so fast, and as you described it, I think very accurately, it's an arms race, and the ne'er-do-wells, for want of an alternative phrase, will employ as many bright young men and women as they can to crack the systems. Inevitably, yes, we want to stay ahead and keep everything safe, but I don't think there's a database anywhere in the world that is actually guaranteed to be safe. End of discussion. Because man made it, so man can unmake it. Michael, followed by Habib, please.
I think from what I gathered with other pension holders, actually, in the private sector, have had their accounts hacked and they've lost data. They are now, I'm seeing, like invitations to join a group action. Now, the only thing I think we can mitigate is that we do lose data. It happens, and then we are looking at that sort of action taken against us in order to get compensation for that. Because once it's out, it's too late to recover data. If it happens, that's it. And so all I can suggest is that we have a fund or a contingency somewhere to help mitigate that. That's the only thing I can think of, apart from trying to obviously keep up with the best considered tactics to avoid it. But that's all I can suggest.
Have a view, Anton?
I wouldn't, in our current position, so as earlier indicated, 95% funded. But if you start working through that, and so if you say currently we're paying out, let's say it's 25 million this year, we pay out more than we take in. Even with no investment return, that's 120 years worth of value in the fund to meet those liabilities. So I would suggest that we have sufficient capital available that a separate pot identified as a contingency is not necessary to our financial security. As and when, hopefully, never, we come across that. And a similar argument could be had for fraud, which is very much linked. But I am aware of actually recently one instance of fraud, but largely that's the only one I've had reported to me in sort of 4 or 5 years. So these things are risks. We take them very seriously. We're doing as much as we can. But as yet, there isn't, haven't had a major breach. And as I say, I suspect that we are sufficiently financially resilient that a contingency is not necessary at this time.
Okay, Habib?
Thank you, Mr. Chairman. Question, perhaps a couple of questions to Anton. How vulnerable are we long-term staff redundancies and sicknesses and recruitment as we are going through various redundancies with public sector? That's one. The second question is, can we be assured that we have adequate funds available to meet our long-term commitments?
So if I take the first one around vulnerability to long-term staff sickness, etc. So in terms of, let's call it public sector pressures, sort of bearing down on resources, that is not an issue because the resources, the manpower resources for the fund are paid for by the fund. So at your request, effectively, in that conversation we have annually around the financial forecast and things like that, if further resources are needed by Rachel or my team, we will have that discussion. And we will tell you we need further resources, and we will tell you how much it will cost. And indeed, Peninsula have increased their. If you go back 2 or 3 years, then the amount of resource that Peninsula has been increasing steadily because the workflow has been increasing steadily. The number of cases they look at has been increasing. The number of members we have overall, although it's less active members, but the number of members overall is increasing. The number of employers we have is increasing. So they're within the investments team and accounting, it's far more steady. The increase in the number of employers does add complexity and workload because you've got to chase contributions from an extra place. You've got an extra code to manage, etc., but not in quite the same way. So in terms of sort of cost management stroke workload, not an issue, but it's at this committee's bequest as to how much resources to place. And whilst not wishing to have unnecessarily too much resources, again, in a world where you can gain or lose £100 million on investments in a month, an extra salary at £30,000 and similar amount of on costs isn't really a significant financial issue. We've talked about vulnerability in terms of how much knowledge is with a relatively small number of officers within the investments team particularly, but to some extent within Peninsula. That's the nature of the beast. And I will come back to you once the Somerset Council structure review is complete to inform you of the outcome of that in terms of resources being offered to the fund. At which point, if you're happy, great. If you think it's too much, that'll be unfortunate, but we'll deal with that. If you think it's too little, then we can look into that. In terms of long-term liabilities, I mean, that is the $54,000 question, as they say. It is a key risk of the fund that we'll have insufficient money in the long term, because that's wrapped up with market returns, mortality, inflation, and the other assumptions that the actuary makes periodically and valuations, etc. Again, I refer to the comments I made earlier. We are 90% funded. That's close to 100. It's not 100, but it's not a scary amount away. It's not 60 or something that would give me rise to palpitations. And at an outflow of 25 million a year on a £3 billion fund, that's 120 years until we run out of money. So, yeah, we are sufficiently funded that we can ride those bumps, and there will be bumps, and there will be another market crash at some point. You know, these things happen; they are inevitable almost. But we have sufficient financial resilience that we can ride those, and they are not of particular concern to me at this stage. Is that okay?
Yeah, thank
you. For those not in the room, the chair has just popped out. I think he's just coming back. Indeed, he is.
Apologies.
We have finished. Well, subject to any other question, I hadn't asked for extra questions, but I've answered Councillor Habib's Falahi's questions.
Excellent.
So I think we're ready to move on.
Okay, in that case, the recommendation is that we note and approve the risks contained on the risk register with the discussions that we've had and the answers that Anton's given. So I suggest that we note and approve those risks. Okay, I'm not seeing any dissent anywhere, so that's what we're going to do. We'll move on to item 11, which is the local government pension scheme fit for the future consultation, which is pages 3 to 68 in the supplementary pack. It's to consider the report from the Pension Fund Investment Manager, Anton.
Thank you. This landed on the 14th of November. The consultation document is a slim 51 pages, and it's a riveting read. I can recommend it. I've read it several times. I've taken the liberty slightly of drafting a response on behalf of the fund. Obviously, given that it only came out on the 14th of November, I didn't take specific in-committee direction from you to draft a response, but given previous events, you've always wished a response, so I've drafted one for your consideration, which I'm assuming comes in at a joyous and relatively small 16 or 17 pages. I'm happy to take direction from the chair as to how much detail you want me to run through things, or whether we're going to assume that everyone's taken in the full 68 pages.
I think what I would like you to do for the benefit of the committee is to highlight the salient points, because I think this is a technical document.
Yeah.
And it is your response that I'm very grateful to you for preparing. And I'm happy to ask the members of the committee if they are content with that as a way forward. But I would like you to come up with the salient points so we understand where we are. I appreciate that the devil is in the detail, and I appreciate that ultimately, if the government says you shall do X, Y, and Z, that we, along with the other LGPSs, will not be in a position to do anything other than comply with the legislation.
I think the first thing I'll say is that government has been, shall we say, at least clever, which feels an unusual statement about government, in that, if you recall, I think it was at the September meeting, we had the last consultation response we looked at and you approved. In terms of the very big picture, where the LGPS community said, please no forced mergers of funds, please no forced mergers of pools, actually, this consultation has broadly taken that on board and not proposed it. So, you know, if we say now, no, we don't agree with any of this, I suspect their sort of implied response would be, well, we did listen to what you said and we didn't include that, so what's wrong with this now? So in that sense, as I say, it feels either that government have been reasonably smart. If I sort of split it into the areas that are in the covering report, in terms of investments, we're in a relatively good place. So they want all the pools to be FCA regulated companies. Brunel is already an FCA regulated company. That was the way we set it up in 2017.
Because that's how it should have been done anyway.
So tick in the box. They want us to pass all our listed assets to Brunel by March 2025. We completed that at Somerset by July 2021. It's so history, it's ridiculous. They want us to pass the management of our legacy investment assets across. That's the 2% that's managed by Neuberger. There's no real advantage to it going across, but as it happens, Brunel already have a working relationship with Neuberger Berman on private equity. So they're already talking to the same people. So if we're forced to do it, it wouldn't necessarily be my choice, but I don't think it has any consequences for us. So in that sense, a lot of those bits aren't of concern. They are reducing the amount of discretion, it's very clear from the consultation that the ambition of government is to, one, remove investment consultants from the LGPS and the cost associated with them. Again, this committee, Somerset, we've not really used investment consultants, so that's not particularly an issue for us either. Although there is a slight wrinkle there that if Brunel are asked to do that, even if we choose not to particularly utilise that service from Brunel, we will effectively share the cost of everyone else doing it, which is a slight annoyance, but hey ho. But they are saying that we want to move the amount of consideration that committees have on input on the investment strategy to a higher level and a simpler level to some extent, and give more discretion power to the pools. I suspect some of this is a slight sledgehammer to crack a nut, in that, again, most of what the government wants, I think we are doing with Brunel already, but other pools aren't as advanced and haven't consolidated what they offer as much as Brunel. So Brunel has 26 offerings. That's all. I believe there are other pools, and I look to Caroline to confirm this, where in theory you might have 50 to 75 options.
I think what I have seen is within specific asset classes, there being several choices in mainstream UK equity.
Yeah. So again, the devil is in the detail, and then some of it might be how we then implement it with Brunel. So there is a world where Brunel continues to offer exactly the same 26. And whilst we only express what we want in equities in our investment strategy statement, we then might have a conversation with Brunel where they say, how would you like your equity to be split between the 12 equity funds we offer? And effectively, we end up very much as we are now. I don't know if that will be possible. I don't know how Brunel will react to that, although bearing in mind that ultimately we own Brunel as well as being the clients. And if that's what the 10 funds want, I suspect we might find a way to get it. So those are the nuances around the investment side. Oh, and sorry, I forgot the other glory of the investments, which is the local investment.
Yeah.
Whether we think this is good or not, we are going to be asked to do it. I personally fail to see the government's talking about something in the region of 30 billion across the LGPS. I'm not convinced there's 30 billion pounds worth of investments out there that are screaming for money that are of really good value, because if there were, people would be doing them already.
It's been done already, yeah.
So that's interesting. I think this is an area where the government could well come back in 3 years' time and say, we're deeply disappointed with your progress, and bring in new further mandations. But it is what it is, and we've got to find a way to make it broadly sensible and workable.
I think one of the, forgive me interrupting you, Tom, but for me, one of the key considerations on this word local is, what does that actually mean? We're talking about larger and larger funds covering a larger and larger piece of the UK in terms of physical space. I mean, for example, if you're on the Isles of Scilly, an infrastructure project in Gloucester is not local, despite the fact that it might be in the same fund.
My understanding, sort of the mood music coming out of government, the sort of anecdotal chit chat that flows around the LGPS, is for government, as long as the answer is the UK, they're not really that bothered.
That's interesting, because at the Pensions Forum last week, which I was happy to attend, there were several discussions on what the government thought of as local.
Yeah.
And also there were several suggestions that, had the government of the day approached them at the beginning, they might have found that there was some assistance from the LGPS to large infrastructure projects, which they believe they would have done at a lower cost than the private sector was offering, and with better returns. Now, that's an idle speculation as far as I'm concerned, because I don't think you can say with any cast iron certainty that you or I, or even combined, you and I, might be able to create some infrastructure projects at less cost than it would appertain if we went out to the open market to do it. So definitely they wanted to look at it, but they wanted to be in much greater control of it, and able to set the limits.
Yeah.
Effectively. Sorry. Mike, sorry. Thank you.
As this goes ahead, I think the important thing that needs to be kept in control of by the people who actually own the assets in the end, which is you, is what rate of return is expected realistically when they're taken on.
Yeah.
Because otherwise you're going to find your rate of return drifts down, and your actuary will therefore have to penalise you.
Yes.
Yeah.
Yes.
And
absolutely.
Yeah. When it comes to local, and again, what I've put in the report is actually, we'd like quite a broad idea of local. And that's, it's partly a realism. Firstly, if you go hyperlocal and say you can only invest in your own county, and that's the only definition of local, firstly, that magnifies the conflicts of interest massively. Two, it makes it much harder work for Brunel. So if we can define local as at least the Brunel area, then Brunel can offer the same thing to all 10 funds, rather than having to do 10 different things. So it's a lot more efficient. The third one is a difficult one, but I think we need to be realistic that Somerset does not contain major cities, major areas of industry, and therefore may not be the best county to offer the best returns. And as so I think, if your patch includes Bristol, I think you can be a lot more sanguine about local. So I think that's a consideration, and that's why I drafted the response as is. And I'm not very keen on the suggestion that it's going to be part of my job to facilitate the creation of great ideas for Brunel to consider. I'm not sure how that will work. The idea that someone will come up with investment schemes that require £100,000 worth of capital, waste of time.
I can't see how that is just going to be considered realistically.
So but to come up with schemes that are sizable, and I think government needs to bring other departments into this, such as something like the Business Bank, the New National Wealth Fund, and the Green Energy Initiative. We need to be able to tap into those, as well as our local mayoral authorities or combined authorities or
whatever comes next.
And obviously, the complexity here is also that the government's moving the boundaries rapidly in terms of what local government looks like. Somerset's working with Dorset and Wiltshire to get a mayoral combined authority. I've heard whispers. I'm not sure how public it is. I heard whispers somewhere that the government's considering making unitaries compulsory.
I've heard the same whisper.
Which the only thing I can say about is, well, thank God we've already done it.
Yes.
Because at least we could do it at our own speed, and it's done, rather than being rushed into something. So
there is an element of truth in that.
As much as they're changing the LGPS, they're also saying work with the local government sector, which by the time we get to it in 2026 might look different.
It will look different by then.
So
okay, well, I know Habib's got a couple of questions.
If I may, it's more of a statement than a question. The headline "Fit for the Future" actually suggested we weren't fit in the past.
Yeah.
So, for the last 5 years or so, maybe longer, I've actually used the future-proofing stuff, which actually makes more sense. That you have capital expenditure and you sort of invest in various projects. Also, I actually refer to the new headlines for. I think it actually. What is doing is allowing investments in local areas and local projects, and that's the aim and objectives in my view. With unlisting equity, am I too far?
No, that's so. That first point around fit for the future. It's the government's view that big investment units are better. I think the empirical evidence around this is less clear than the government would suggest, but the government is excellent at cherry picking reports that back that up. The stuff on fund and pool governance, which we'll get to in a minute, they are encouraging a general move to greater professionalism in the LGPS, and greater and higher. They are mandating higher standards. That's not to say that those standards aren't being met, at least in pockets. That follows the Scheme Advisory Board coming out with a good governance report in 2019 that the government have successfully done nothing with for nearly 5 years. So effectively, the LGPS community has been saying for 5 years, we would welcome greater strictures on our governance arrangements, and government haven't been doing a lot with it. And so in that sense, it will make us more fit for the future. Yeah, I don't have a problem with those areas. So in that sense, yes. At the end of the day, though, on the investment side, the government is big is beautiful, big is cheaper, and cheaper is always better. If I move on, I'm happy to go back to questions on the investments. But if I move on to the fund governance stuff, as I say, to a large extent, anyone who's read the Scheme Advisory Board's Good Governance Review, there's nothing in here that's a surprise, and a lot of it is very worthy stuff.
Yeah.
The idea of a statutory senior LGPS officer is generally considered to be a good thing.
Yeah.
Someone that you can go to and say, you are the person responsible, you are the officer responsible. Yeah. And it's mandated. And also that person, one, should be sufficiently senior, but also the LGPS should be their main priorities. So the suggestion that it should be someone different, probably from the Section 151 officer, and therefore you are removing some of the conflicts of interest inherent in the fund not being a separate legal entity from the administering authority. Yeah, I can't say I'm particularly keen about a biannual or triannual inspection regime, but it's hard to argue that it wouldn't improve professionalism. I think you should note as members of the committee that there will be a more formal, although we've already got a training policy and encourage you to do training, etc. I expect when we get to the guidance on the new governance and training strategy, there will probably be more encouragement, we'll call it encouragement, for you to engage with training. I think we are going to have to be more strict of providing training and getting you to do it, and that I will probably need to procure training more regularly from externally to provide that. So it's not something to necessarily be scared of, but I think you should be prepared to give up more of your time as pensions committee members. I think that is a likely consequence. Again, it's hard. It's extremely hard to argue against the idea that you should be properly trained and knowledgeable about the areas you are making decisions on. Right. But it's something you should be aware of. And again, there's a requirement or a suggestion that all funds should have an independent advisor. Again, we at Somerset have had that since before I joined, so it doesn't feel like a big step for us. And there may be some strictures over that in terms of whether that there's some areas are suggesting that it should be, and they might mandate it, that it's a voting member of the committee rather than a attendee.
Yes,
I'm sure Caroline will probably take the fifth on quite a few matters when it comes to it. We'll see how that goes. But so that's the areas around the fund governance. There are then some areas on pool governance. The most interesting of which is that I think there is going to be a requirement for a shareholder representative, a representative of the funds, to be a non-exec director on the company board. Now, within Brunel, we currently do have a shareholder non-exec who is responsible for liaising with the shareholders on behalf of the board, but it is still a board appointment rather than an appointment of the shareholder funds directly. So that's one to look at or to watch. But there is a slight nuance there in terms of, well, if you are a formal director of a company that is an FCA regulated company, then you have to meet the requirements of the FCA in terms. So I'm not quite sure how that will work in the idea that maybe a councillor would become a non-exec director, because I'm not sure they would pass the FCA's requirement.
For me, I think that is the issue on that particular item, is I'm not aware that any of our current 110 councillors are FCA compliant. I mean that in the nicest way. I'm not aware of any. I could be wrong.
Okay,
but
it's still,
sorry,
there's still some nuances there to be worked through, and we'll see how that one goes.
I mean, one would hope that any non-exec director would have some knowledge, at least a working knowledge, if not to try and ensure that they were able to carry out the functions properly.
Different shareholders, and they have radically different views about whether they are happy or not.
Well,
yes,
that's indeed true. Yes,
and you know, behind the four walls of Brunel, my understanding is that we are a relatively coherent pool compared to some. But there are regular behind the walls. There are regular disagreements, and you know, we work through them to come to a consensus. And
okay, I know John had a question, so I'll bring John in at this point. John,
it was more of a statement. I was going to say, I think that's to be explored, isn't it? I mean, the fact is that not very normally what happens with the non-executive directors is they're brought in because they have a different expertise to the pool of normal directors, and that's the normal way about it, isn't it?
Or sufficient expertise to question the executive director. I mean, I have seen in other areas. So obviously, I've drafted you a consultation response. I've seen a few other council ones. Devon's was particularly early because their committee sat on the 2nd of December. So my colleague at Devon had to draft his early. And if you were to compare and contrast ours with Devon's, you may find some similarities.
Yes,
because that's an easy drafting. That's an easy drafting point for me to start with someone else's. I have seen in some quarters suggestions that the government should make more recognition of the slightly unique status of LGPS pools as FCA regulated companies, in that they are very odd in that they basically only have a prescribed number of clients. They are not seeking more clients per se. Their clients are exactly the same people who are their shareholders. There is direct alignment there. And other than for the needs of meeting the FCA's liquidity and capital buffer rules, they are not profit seeking either. And all of those things make them quite unusual beasts as regulated investment companies. And perhaps the government should recognise that and in some way in the regulations. Again,
the devil will be in the detail.
The devil will be in the detail. I'm not sure there's a right or wrong answer. We'll see what they come up with.
Okay.
I don't have anything. That's sort of my canter through the areas of. Well, is there any specific questions within the response?
I don't have any. Having read the draft response, I thought it was a perfectly more than an adequate response. I'm very grateful to you for preparing it for us. I'm quite happy to propose that we accept this and send that off. If people are concerned about something, please raise it now, because I will work with Anton and try and make sure everybody is happy with it. Paul, you have a query, question?
Yeah, just partly to reiterate, but also I'm just wondering about the emphasis. The real concern I have here, fully accept pretty much everything you've said, Anton, in terms of this is much more reasonable than we expected, etc.
Yeah.
The only thing that really causes me concern is that local investment, even if local means the UK, because if you make the shopping basket smaller, and I think, as you've said, there is not an enormous number of valuable infrastructure projects out there now with a return. If you make it smaller, the choice is smaller, inevitably the return has got to be smaller. And for me, that means if you depress the return on the fund, you've got to put up employer contributions at some point, and that's a pressure on the public purse. This feels exactly the same as when we say we'll save money by not doing repairs and maintenance, and then you just stack up a problem. We will depress the return and we'll have to hit the public purse. And I think that's the issue.
I mean, if you make the assumption that a significant number of these local investments will be projects that otherwise would not happen without government support, it's sort of a circular argument within government. You're robbing Peter to pay Paul. The other thing is that, again, it will be interesting to see what number the government mandate, or whether they're going to go for a sort of comply and explain. But if it's 5%, if we make the assumption that we're going to get 2% less on that 5%, that is a relatively small overall number. It's not ideal.
It depends on the modification.
Then you sort of, whether you get mission creep or something. But I absolutely, I mean, from an absolutely personal level,
Have a great Christmas.
I just find the whole idea barking and wrong. I just think it's economically just wrong, stupid thinking. I think it's the economics that you would expect to be taught in the third week of a GCSE class would tell you this doesn't work. But
maybe they played truant.
The overall impact of it is probably we shouldn't get too excited by. I mean, I'm also very concerned about, you know, if the idea is that we're going to get lots of small projects, just the workload of me or someone at Brunel just formally going through a stack of really stupid things and just saying no, and perhaps having to write half a paragraph of justification for no, even if it's too small or inadequate return, or, you know, not sufficiently developed. It all takes time and resources. And to do due diligence properly on investment proposals is a very time-consuming, and that's a cost. And that concerns me just as much. The sort of industry that's going to have to be created around managing this concerns me just as much as the investment returns that may or may not come from it. It's a bizarre thing, but you know, government are extremely keen on it. And in fairness, you know, the previous government were moving towards it. So it doesn't seem to be a party political sort of blind spot. It seems to be a politician or a central government blind spot.
Government are keen on it, I think, because in the same way as they wanted debt off the books previously, and therefore they went down the PFI route. This is a route to get investment for things that
Yeah.
government should be doing and not put it on the books. I appreciate absolutely what you say about the 5%, but I am concerned with Mission Creek because changing it from 5 to 10 or 15 is far easier than the
Yeah.
global structure. But as you say,
I-
I don't understand
Well,
what it's
and-
designed to achieve for pensions. And
Yeah. And yeah, I said it offline to one of you at the start. My feeling around this is that I'm not entirely sure that government isn't setting us up to fail. I can't see how we're going to collectively, as the LGPS, reach the 30 billion, especially as it's private equity. So you would expect that to be drawn over a decade. And I just don't see how that's going to square with a government that's going to come back in 3 years and say, right, what have you done? And I think they're just going to say,
your progress to date.
we're not happy with your
Yeah.
progress today, and so we're going to do something else to speed it up. And that to me feels like just where we're going to go.
Well, they don't-
Just as I said, when we created Brunel, they've asked
Sorry.
us to do a 30-year business plan. I don't think it will last 5.
Yeah.
It's lasted about 7 without meddling. So I suppose I was unduly pessimistic.
Well, I don't think you're unduly pessimistic. I mean, I think the part of this problem is we have central government politicians thinking in 5-year cycles. And we had a discussion earlier today about what our funds have done over a 20-year cycle. And there is a world of difference between a 5-year cycle and a 20-year cycle.
Yes.
And I think that thereby, but I think we're agreed that it's the devil will be in the detail. Michael, you said you had a question.
It's on the same subject. It's to do with our response really, and you've mentioned 5%. Is that just picked out of a hat? I mean, that's the sort of level you're thinking they might try and get us to commit to.
I'm fairly sure I'd have to go back and read it. I think the 5% is quoted in the document.
And that would have to be in our investment strategy.
I have seen it somewhere.
Yeah. Okay.
Well, one of the things I have pointed out in the detail of the response is they're saying this is how we want you to set your strategy, but it doesn't have a box that says local investments. So they want us. There's a disconnect with how they want us to do the investment strategy and how they want us to commit to local projects. And I'd like them to at least rectify that disconnect. Because at the moment, what it feels like is we say we want this much in private equity and this much in debt and this much in listed equity. And then it would be Brunel's decision as to how to extract from that the 5% we've said is in local and decide which pots to take it out of. And that just seems very strange.
What I would suggest that you throw it back at them and say, well, we're not quite sure what sort of investment you envisage, but if you're prepared to pay for the extra admin costs that this would incur in terms of officer time, etc., due diligence, expert advice, then we might consider doing it. Because the point is, they're saying this is going to cost you. It's going to be aggravation. It may not even be a benefit to you, but we want you to do it.
Yeah, and that is in the consultation response that we are concerned around the costs of doing this. And yeah, I suspect the answer, if we went more blunt and said, yeah, and actually, yeah, strictly speaking, I have another meeting with MHCLG representatives on Monday as a conference call with all the other Brunel funds. So yeah, the 10 funds will be in a virtual room with 6 civil servants. And if I said to them, I've had one of my councillors suggest that you pay for the additional thing. If they were being honest, I would expect them to burst out laughing.
I don't think an unreasonable request, but there you go.
Yeah.
Thank you.
It's one of the I don't think I've ever quite got used to the idea in the public sector of you have to just put up with the stupidity of central government. It's just
Yes. Okay, well, I have suggested that we are, that we support the draft as written by Anton. So unless there are any immediate changes that people want, so,
I think it's for the heating, but tell them it's too late.
right.
Carry on with the meeting.
Yeah, and it is what it is. Sorry, yeah.
Yeah.
The one thing I would like to just put on your radar, Chair, if I may, is obviously within the timescales of this, the pension board do not have a formal meeting before the
16th of January, which is one of the reasons why I
so I am going to share it with them online.
yeah.
And if they have significant representations, then I'd like to have a route through you in consultation offline with the that we could tweak it if necessary. I don't think I'd be surprised if they came up with anything significant, but I think we should give them that option.
Committee, are you content if that happens? That Anton and I have a conversation and come back to you with the suggestions that may come from that. Like Anton, I don't think there's going to be any, but it's a possibility and we need to cover it off. So are you content with that, committee? Yeah. Yeah, they seem to be content with that, Anton. So I think we'll go with that because it's we've got to be pragmatic about it.
Yes.
And you know, we've got to get the consultation done by the 16th.
It is
so
I mean
a month, you know.
I think there was one occurrence out of the 3 consultations we've done this year where there was absolutely no way of getting them in front of committee or board, and we had to do the whole thing offline, and that was certainly
challenging.
In terms of just engaging transparency and giving the public the chance to engage, it's rather disappointing.
Well, yeah.
But engage with us in terms of how the fund responds. Obviously, all individuals are free to put in their own response should they wish to.
Of course, but I think it's important that we put a cogent argument forward, and I think you have done that. I didn't see anything in your draft response that waved red flags at me going, no, Anton, that's sparking mad. So the committee are happy to do that. I'm happy to have the caveat that if there are some responses that we need to look at and look at again, that you and I will have a conversation, come up with a draft, and circulate that for people's comments, and take those comments into account when we receive them.
Yeah, that's fine.
I'm conscious that it's the 16th of January and there's a couple of bits and pieces and people will be off on their Christmas break, Christmas New Year break. So we've probably got about 5 actual working days in which to deal with this, if there were any comments. So if you do receive an email from Anton and I on this, I appreciate it's the festive.
I would probably give the board members until after the Christmas break to come back to me.
Yes,
and that then gives us a sort of full week.
A full week
to deal with anything that comes out of it.
I would enter a plea, ladies and gentlemen. Would you please respond as promptly as you can, because we at best we'll only have 3 or 4 working days to get it back and circulated around with a revision if and when required. Okay, everybody seems to be very content with that, Anton. So again, my thanks to you for putting the work in, considering the timescales.
Well, there's nothing I enjoy as much as writing a response to a government consultation. I mean, it's the joy that keeps.
Say that again on the 19th of December when the financial settlement comes out.
I am
lucky to create on the 19th this year, which is 2 days earlier than it has been. So
I am lucky that the nature of my responsibilities are that I don't have to particularly engage with that personally.
No. No, I think
I
we
used-
lost something pages last year.
Yeah, I used to sit next to the CCN SCT
Yeah.
sort of advisory team in the office, and they would get very excited basically the last working day before Christmas.
Yes. Yes. Well, there we are. Okay, that was the final item apart from any other business. I'm not aware of any other business. So unless anybody's got anything to raise, I'm not seeing anybody indicating that they have. So in that case, I will formally close the meeting and thank everybody online for joining us, and my colleagues here today. And again, my apologies for being late. The traffic was absolutely awful. A 30-minute journey took 85 minutes, which is monstrous.
Well, you were unlucky.
Well, maybe.
Call that an 85-minute delay.
Yes.
Out of interest,
Could
which way did you come? Because I came a bit. I gave myself more scope to be late, but